Have you ever had this thought, I've been making this mortgage payment for years. Of course I'll qualify to keep the house. I hear that all the time. And honestly, it makes sense. You've lived in the house, you've helped make the payments, you know exactly what the payment is. You know what the taxes are, you know what the insurance costs. So naturally, you assume qualifying to keep the house after divorce should be simple. But here's the problem. Mortgage lenders don't approve loans based on the history with the house. They approve loans based on your ability to qualify today. And that surprises a lot of people. In fact, some of the most heartbreaking conversations I have are with people who negotiated an entire divorce settlement around keeping the house, only to discover later that they don't actually qualify. Today, I want to talk to you about the biggest qualification mistakes I see people make and what you need to know before negotiating your settlement. Because once an agreement is signed, your options become more limited. Let's talk about the biggest misconception. People think, I've been making the mortgage payment, therefore I can afford it. And affordability and qualification are not the same thing. You might be able to comfortably afford the payment. You might have been making it for years. You might be incredibly responsible with money and still not qualify. Why? Because lenders use guidelines, and those guidelines don't always align with real life. Let me give you an example. Let's say a couple earns around $180,000 together. Now they're divorcing. One spouse wants to keep the house. The mortgage payment is around $3,000. During the marriage, that payment may have been perfectly manageable. But now we're looking at one income instead of two. And suddenly those numbers look very different. This is where people discover the difference between household income and individual income. And that's often the first shock. Now let's talk about support income, because this is one of the biggest traps I see. Many people assume I'm receiving support so I can use it to qualify. Maybe, but not always. And this is where things get complicated. Support income generally needs to meet specific guidelines before it can be used for mortgage qualification. There are requirements around the receipt, there are requirements around continuance, and there are requirements around the documentation. And every loan program has different rules. I've seen people assume that they could use support income only to discover later that the timing didn't work, or the documentation wasn't sufficient, or the continuance period didn't meet the guidelines. And suddenly a plan they thought was solid starts falling apart. This is exactly why I tell people not to negotiate based on assumptions. You need to understand how the income will actually be viewed by underwriting. Another issue I see all the time is debt. Many people focus only on the mortgage, but lenders look at everything: car payments, credit card payments, student loans, personal loans, HELOCs, all of it. And I've had clients tell me, Tammy, the mortgage payment's only $2,500. But when we look at the rest of the monthly obligations, the picture changes dramatically. The mortgage isn't always the problem. Sometimes it's everything that's surrounding it. And let's talk about a really dangerous assumption. And I want you to pay close attention to this. Many people believe that if the divorce decree says that their spouse is responsible for a debt, that the debt automatically disappears. That is not always true. Let me say that again. Just because a divorce decree assigns responsibility doesn't necessarily mean the debt disappears. This catches people off guard all the time. I've had people sit across from me absolutely convinced they were ready to buy or refinance because the divorce was finalized. Then we review everything together and discover there are still qualification issues that need to be addressed. Now, I want to tell you about a conversation that I recently had. A woman came to me absolutely certain she was going to keep the house. The attorneys were discussing settlement terms. Everyone was moving forward under the assumption that refinancing would be straightforward. Then we ran the numbers. The issue wasn't the house. The issue wasn't her credit. The issue wasn't her willingness. The issue was qualification. And because we discovered it before the settlement was finalized, she then had options. We could adjust the structure, we could negotiate differently, she could explore alternatives, she could make decisions from a position of knowledge instead of hope. That's the real value of planning, not getting a specific answer, getting the answer before it becomes a crisis. Because here's what I want every divorcing homeowner to understand. The worst time to find out you don't qualify is after you've already signed an agreement that requires you to refinance. At that point, stress levels skyrocket. Deadlines start approaching, conflict increases, and everyone wishes the conversation had happened earlier. This is why I spend so much time talking about planning before settlement. Not because I'm trying to make things more complicated, quite the opposite. The earlier you understand your options, the more options you usually have. So before you negotiate around the house, ask yourself 3 questions. Number 1, do I know exactly what income can be used? Not what I hope can be used, what can actually be used. Number 2, do I know exactly what debts will be counted? Again, not what I assume, what will actually be counted. And number 3, have I verified my qualification strategy before signing anything? That question alone can save months of stress. The truth is, keeping the house after divorce isn't impossible. Many people do it successfully. But successful outcomes usually happen because they planned first and negotiated second, not the other way around. If you're currently trying to figure out whether you qualify to keep the house, put the word qualify in the comments. I'd love to know where you are in the process. And in the next video, we're going to talk about something that surprises people even more. The difference between being approved for a mortgage and actually being able to afford the life that comes with it. Because those are not always the same thing.